Hi everyone, in this video I wanted to demonstrate how to perform basic quantitative risk analysis using AI, publicly available AI, either Risk Awareness Week GPT, Insight SHAT GPT, or Gemini Advanced. First, I want to take a step back and start by interrogating and brainstorming together with AI, just like you would with a junior quantitative risk analyst. You would normally describe the problem. I want to estimate potential losses from an incident on a particular piece of equipment. How would you suggest we do this if I want to represent losses as a distribution? Give me a few short ideas. Let's see what it comes up with. It's suggesting we can simulate the potential distribution of losses. We can use historical losses as an indication. We can run some hypothetical scenarios and use more complicated methods. We can also ask experts to estimate their losses, which, by the way, is a great idea. Ask experts first, so you have a baseline to compare with whatever you simulate or quantify and see whether quantitative risk analysis outperforms or is more representative than qualitative expert estimates. Always do the qualitative first, then compare and see for yourself, because many risk managers are still not convinced that there's a significant difference between what the experts tell you and what the data shows when you make the effort to analyze it. They think it's a small deviation, but most of the time, it's actually a very significant difference. Let's use Monte Carlo simulation as our base case. I would like to use Monte Carlo simulation. What distributions would I need to develop a distribution of financial losses for a piece of equipment? It doesn't have to be a piece of equipment. It could be the whole plant. The math behind it, and this is the beauty of quantitative risk analysis, once you understand the math in a simple exercise, it's exactly the same for most other problems. So this is suggesting your risk from equipment breakdown is actually a product of 5 things. It's basically an equation. It's the frequency times the cost of the incident. The cost includes the repair of the equipment plus the duration of the incident. So frequency of incidents times the cost of repair plus the duration of the incident times the production loss plus other costs. I'm simplifying a lot, but I want to put things in simple language that explains the steps. Is this a fair description of what our loss distribution would look like? How can you explain it in simple, maybe graphical terms? It's confirming that our total loss, which is a distribution, is a product of a few inputs, a few assumptions, how frequently we experience incidents, and for each occurrence, what the typical repair cost is. This is also a distribution. How long the incident lasts is also important because we can calculate the production loss. Technically, we could calculate the duration of an incident and multiply it by the cost of a lost day, then add other costs. But let's simplify this. So the total cost is the frequency of incidents times the repair cost plus the production loss, which is the product of incident duration and the cost of 1 day of production loss, plus other costs. We have 4 variables. For illustration purposes, we don't need 5 variables. I think it's enough for us to look at the frequency, the repair cost, the cost to replace or maintain the equipment, the business interruption, how much money we lose from stopping operations to fix the equipment, and possibly some other costs. It gives a nice summary: environmental costs, regulatory fines, and additional costs that weren't included. This looks really good. It also suggests that each of these could be modeled as a distribution. It's still suggesting modeling the number of days and the production costs separately. Let's break it down. I want to start with the frequency of incidents distribution. Imagine you're a risk manager interviewing the head of production. Please ask me all the questions you need to collect enough information to build a Poisson distribution. It's suggesting a Poisson distribution to represent the frequency of incidents. Ask questions in simple business language and keep them brief, as we want something simple and quick for illustration. For example, we see here, how often do incidents typically occur with this piece of equipment, per month or per year? Can you provide historical data on incidents for the past few years? Are there any periods where incidents are more likely to happen during production times? Have there been any significant changes in operations that might affect the incident rate? All of these are excellent questions that you could discuss with someone in operations. You would get responses quickly. For illustration, let's say over the past 3 years, we experienced approximately 7 incidents per year. Sometimes more, sometimes less. No particular seasonality, no major changes in production. Can you use this information to build a Poisson distribution, show it graphically, and create a downloadable file with 5,000 trials? Not bad. Usually, you would use specialized software to convert this interview data into a distribution for calculation. Here's what it looks like, from no incidents to a very unlikely number of around 17 incidents per year, with an average around 7. We can download this as a Poisson incident frequency distribution. Pretty good. Now continue acting as a risk manager. Ask me 5 questions to determine the appropriate parameters for the repair cost distribution. For example, what is the typical cost range for repairing equipment after an incident? Minimum, maximum, most likely. Can you provide examples of past repairs for similar incidents? Are there factors that significantly influence the repair cost, such as specific equipment that is more expensive? How consistent are the costs? Do they vary widely? Are there any standard repair procedures or protocols that affect costs, such as specific vendors or parts? Excellent questions. Let me act as the head of production again. On average, repairs cost around $10,000. However, most repairs are inexpensive and can be done in-house, starting at $1,000. Rarely, repairs can go as high as $50,000. Please convert that into a distribution. Which distribution would you recommend? Maybe try fitting a few different distributions and show them graphically. Okay, from here, we can see that it didn't work. This is where patience comes in, and you really have to be ready because I want to keep this in the lesson to show that sometimes it just cannot perform the task, likely because the values I provided are not realistic enough to fit standard distributions, possibly due to using vague terms like rarely and most. Let's see if we can improve on that. Show a graph for the triangular distribution with the parameters I mentioned. Let's ask it to show it separately. Looking at this, it seems incorrect because we have some negative values. This doesn't look right. The $10,000 standard deviation of 14 also doesn't look right. How many trials did you use for the triangular distribution? It's unclear why it's not showing a continuous graph. It's just showing bars, which seems unnecessary. This is with 1,000 trials. Okay, show me a graph with 20,000 trials. Now it looks more reasonable as a triangular distribution. What I wanted to point out is that sometimes, just like a human risk analyst, it will give you results that don't make sense. It's easy to see this makes no sense, as it's just one line, not a real distribution. Something is clearly incorrect. Sometimes it assumes a low number of trials, like 1,000, which doesn't form a proper triangle, and you have to continue interrogating it. If you switch to the new interactive graph, you can see specific data points, though it still shows 0 sometimes, which is not helpful. Switching to the old format makes it look more like a normal triangular distribution. Let's use this for our future analysis. What other inputs do we need? We have frequency and repair costs. Now we need production loss. For production loss, instead of suggesting a method, let's ask which distribution we should use to simulate losses from production stoppage due to an incident. We see that the AI suggested 2 types of distributions, Weibull, or exponential. I choose the Weibull distribution just for illustration purposes. I want to use the Weibull distribution. Can you act as a risk manager and ask questions to determine the parameters needed to build the distribution? For example, how long do stoppages typically last? Does the risk of longer stoppages increase as equipment ages? What is the most common duration, the mode of the distribution? Great questions. Now ask for just the minimum data inputs needed for Weibull. The first input, duration of downtime, let's say 10 days. Great. Second, does the likelihood of longer stoppages increase? Yes, it does. Third, what is the most common duration? Average is 10 days, most common is 12 days, with a minimum of 4 days and a maximum of 20 days. It's doing some calculations, and as you can see, we're having a normal human conversation. Even though it's calculating beta and eta, I don't need to know those details. It's a normal conversation. I'm making up the numbers, so the graphs might not be perfectly realistic. Simulate with 5,000 trials. Let's see. It made the graph available for download. Let's see if the simulation results are different. All right. Let's ask, can you also make the triangular distribution above with 5,000 trials available for download? I'll save that now. As a general rule, it's better to save the results immediately and not rely on going back to old calculations. Since we haven't done too much yet, it should be fine. Now we have 3 distributions for risk. What else are we missing? What else do we need? We need the other cost distribution, and then we need to aggregate them together. Okay. So let's assume other costs are log normal with average of 500 with moderate volatility. You make an assumption of what moderate is. Do 5,000 trials, graphically show and make available for download. In the meantime, here's what the distribution looks like: a high chance of nothing significant, then a moderate chance of something in between, and again a high chance of a catastrophic event. Let's assume this represents our observations and discussions accurately. The log normal distribution looks fine. Let's download that as well. Now let's perform a Monte Carlo simulation to calculate the aggregate risk by combining the distributions using the methodology we designed. Start by summarizing the methodology, so I can double-check it, graphically represent the loss show as both histogram and loss exceedance curve. Let's take it step by step. There's a lot more you can put into this prompt. We have 4 inputs: frequency, repair cost, production loss, and other costs, with 5,000 trials each. Great, let's perform. Thank you for showing us the code. It's doing the calculation, running 5,000 simulations based on the risk assumptions we provided to calculate the total risk. Great, here's the loss exceedance curve. A high probability of a low incidence and a very low probability of something catastrophic, up to $600,000 in losses per year. That's significant. The graph shows losses ranging from 0 to a very small probability of $600,000 in losses from this risk. It's available for download now. Now let's interrogate this, because this is only the beginning of the risk analysis. Let's continue. Looking at the total loss distribution, give me the key parameters: 90% confidence interval, expected losses, VAR 95, unexpected losses, CVAR 95, and any other metrics useful for decision-making. Also, explain each metric and how it can be used in practical decision-making during the annual budgeting cycle. Let's see what it comes up with. On average, we expect to lose $222,000 per year from this piece of equipment. This basically means that this is the baseline budget for incident-related costs. Unless you plan to take action to mitigate the risks, this amount should be added to your maintenance budget, as it represents your expected incidents. Based on the history of incidents with this equipment and the risk assumptions we've made, this is the extra amount that needs to be included in the budget to avoid overruns. This represents the average expected losses from this piece of equipment. It also provides the median, standard deviation, and confidence interval. So 90% of the time, losses from this equipment will range between $87,000 and $380,000. The VAR 95 is $380,000, meaning 95% of the time, losses won't exceed this amount. However, in the worst 5% of cases, the average is $425,000. I don't love the way this is explained because it's too technical. Let's copy the value of CVAR from the result we received and try again. Explain this to a non-risk business person. What does this number mean? And what are the implications for budgeting, insurance, and capital allocation? The worst-case scenario represents the tail beyond the VAR. In layman's terms, this means that while 95% of the time losses will be below $380,000, 5% of the time they could average as high as $425,000. Unexpected losses show how much capital should be reserved for the worst-case scenario. It also gives suggestions for how to use these numbers. As a golden rule, never take the first AI response at face value. Always keep digging, asking questions, and refining the analysis. Remember, this is like working with a junior risk analyst who just finished a master's degree in quantitative risk analysis or probability theory. They bring you the analysis and some suggestions on how to interpret it. You can ask follow-up questions without embarrassment as you're speaking with AI. You can ask anything, even seemingly silly questions, and it will keep helping until you are satisfied with the response. What does it say? Let's take a look. It says to use the average loss, $222,000 in this case, to set a baseline budget for incident-related costs, ensuring no surprises at the end of the year. This covers expected incidents. This baseline is useful for deciding how much to spend on mitigations and evaluating how effective different mitigation techniques, such as preventative maintenance, will be in reducing expected losses. Expected losses serve as a baseline. If the cost of mitigation plus the recalculated expected losses is lower than the current expected losses of $222,000, the mitigation is worthwhile and should be implemented. We can use the 90% confidence interval or VAR for reserves, rainy day funds, or risk capital calculations. We can use the CVAR to understand how much insurance is needed for this equipment, but often it's better to just insure the full value of the equipment. It opens up different applications for you, and you can continue investigating each one. Now let's look at what it said about CVAR. At the moment, it's not very helpful, as it basically repeats the same thing. It says CVAR is the average of the worst 5% of these potential risk scenarios, which is correct, but not helpful yet. This becomes more useful when budgeting. Normally, you would include expected losses in the budget to ensure there's enough capital allocated to cover them, as they are expected to occur. Then you consider the worst-case scenario. How much money do you need to have available, either in equity capital or liquid form, to cover these worst-case scenarios? CVAR is useful for this as it shows that in the worst case, you would lose $400,000, or whatever the value is.